Good morning, everyone. Welcome to Outside In. This is our special edition with two guests this week on self-managed super funds and why or if I should and what that looks like and in great detail. And today, to talk us through that process, we have Poonam Delorio from Be Limitless and Zayna Chaya from Liquidity Financial. So is that right?
Yes.
Yeah, okay, good. I always get so nervous on the intro, which is so weird. But yes, welcome, ladies. So firstly, I'll get you both to, I guess, tell me a little bit about yourself, how you got into the industry and what you do. So Poonam, welcome.
Cool, thank you. Thanks for having me, Zoe. So I actually started my career as an accountant. So I did my chartered accounting and I also did a finance degree. And I started with the traditional accounting tax. And for some reason, when I was a graduate, someone said, oh, we need some help in the SMSF division. And I didn't know what superannuation was. I didn't know what SMSF was. And I went and did some work for them. And I found the accounting side quite easy compared to doing normal tax returns for companies, trusts and things. But what I fell in love with was the financial planning side of things, the share market. People had properties in super, which I never knew could happen. So I kind of did that for a bit, went back and did tax, and then I decided I wanted to specialize in superannuation. So I did that for a bit. And what happened was there's this thing where accountants are not allowed to give advice. They can only give factual information. Financial advisors could give advice. And I thought, well, I can't really do my job properly when I know what I need to tell the clients, but then I have to refer them to someone else that might not really know them in depth. So I decided to do a diploma of financial planning and finish my studies. And then I became a full-fledged financial planner. And I just superannuation in general is really, really interesting to me. But self-managed was great. I mean, I saw people who I thought you'd have to be extremely wealthy to have a self-managed super fund. But I saw people that were just earning normal incomes, had made some really good decisions, put some properties into their fund, made some really good investment decisions, had a bit of control and retired on millions of dollars. And I just saw super in a whole different way. And I thought, okay, this is something that I can do. This is something we can look at. There's estate planning benefits with it. Yes, you can't touch it until you're 65 or 60 and retired. But that's kind of where my passion for financial planning and accounting. And I felt both kind of go hand in hand because when you're looking at the finance side of things, it's a lot about the share market, the property, how will I retire, how much money will I have, all this stuff. But a big part of it is also the tax structures, how to save tax, how to, sort of compound that and make sure that you're doing the best. So I felt they both came together. So I've been doing this for, over 20 years or so. Started when I was 10. But
now, that's rare though, isn't it, to find someone who's a financial planner and an accountant?
It is. It's very rare. And I didn't realize how rare until I went out on my own.
Yeah.
And I thought, okay, I'm going to set up this business. And I realized, can't set up one company. They're two separate businesses. They're run by different bodies. One is governed by the ATO and one is governed by ASIC. Two different. Everything was different. It's like running two businesses. And I thought, oh my God, do I want to do this? And slowly I found out that this was a little niche and there's not many people around Australia. There's a few, but not many. It's quite uncommon. And then the other thing that sort of is a little bit different as well is having the SMSF accreditation and someone who's literally worked with self-managed super funds for over 20 years. So I have all those, which I think was really good, funnily enough. I'm glad I persevered and kept both because it was a bit painful, but it's been great. I know how they both work. I work with financial planners. I work with finance people. I work with accountants. I can put different hats on and go, this is why they want this. This is why they want this. And sometimes the clients come and I just understand the language for both.
Yeah. Seems crazy that they're not together, right? Because you don't want to be referring someone and be like, oh, can't answer that. Now you got to go speak to them. And then, oh, can't answer that. Now you got to go speak to the accountant. It just, that feels a little bit, crazy.
It does.
Yeah.
It's crazy. And really, we've got a shortage. This is just going off on a tangent of financial advisors. But I think accountants should be allowed to be able to have that qualification to be able to do both.
Yeah.
But here I am. I've got them both.
Oh, wow. So we have a unicorn here today, everyone. Yeah. Don't make her too busy because we need her. And Zayna, you have got a great background. So.
Oh, thank you. Thanks for having me on the podcast, Zoe. And so my where I started in mortgage broking was it was introduced to me by a friend and they suggested that, it could be something that's really good for me. And it suited my personality and it was great. And at the time I was working in the mining sector doing, commercial credit and risk analysis and, really doing that analysis with creditors and see how we were doing there. And I was getting to that burnout stage, working a 9 to 5. I wasn't enjoying it. My kids were really young. And I thought, yeah, it's a perfect time for me to just grow myself, step away from the 9 to 5 and try and build something of my own so that I can actually make a little bit more of a difference.
Yeah.
And my passion for finance grew in that process as well. So just really being able to help people a little bit more. And a lot of, I suppose that's being with Liberty as well. Some of the clients that I've been able to help, I've found them in really difficult places and feeling, that satisfaction of being able to help someone and relieve them of so much cash flow pain or really put them in a better position has been amazing. It's the hardest part is, like the way Poonam said, is we can't give advice, just like accountants can't give advice. And so there is a lot of handballing, and we've got to make, sure that we've protected ourselves. We don't say the wrong thing. Our clients don't act on anything that we've said without getting proper advice. So it's tricky, but I've really found a passion for doing that. And yeah, now stepping into the commercial world as well and self-managed super funds, there's just so much you can do with finance out there.
I feel like you don't get taught this stuff. It makes me so freaking mad. I was like, what a waste of space was year 11 and 12 and 10, and half of it. At least a quarter of it should have been how to manage your own life, like how to be better off from the start, how to set yourself up for the future. But you know what? Maybe we take it all down with one podcast, just a small part of it. But, it's the things we want to know, right? But I find it fascinating that both of you, it's probably like since kids, you've like gone, and I feel like I was the same, and I speak to a lot of people, you go, F this, I'm not doing this anymore. Like there's got to be a better way to achieve better results. And it always ends up being not working for somebody else, is taking a creativity on a new path and finding it and doing it. And you're both absolutely nailing it in those areas. You're a unicorn accountant and financial advisor. And Zayna, you're doing all types of lending, like self-managed super funds, commercial and residential, everything. But you get to both do it from home or wherever you like in a beautiful bougie co-working space, or, from home. So you've got that freedom with the kids, like amazing. So if I have $150,000 in my super, and so does my husband, which I'd say for most 40-year-olds is probably about the average, combined together, what's the steps of, I guess, going down the path to seeing if that's a viable option for us? And I think we'll tackle every question really for a double part, right? So first part, we'll go to Poonam and then we'll go to the finance side and carry on the conversation. Yep. Good? All right. So Poonam, should I opt for a self-managed super fund or my husband and I with that amount, and like what's involved in doing that?
Okay, that's a great question, and that happens a lot. People ask me that a lot because superannuation is forced savings. Mm-hmm. You've got more money and you've got more deposit than you would generally. And what I say is, because it is superannuation, self-managed is a financial product, and I have to just give that disclaimer. Whatever I say today is general in nature and it's not advice. It's just factual information. If you do need specific advice, please seek a financial advisor. But just getting that out of the way.
Yeah.
It's literally what we do is we sit down. So we can't just go. Back in the day when I started my career, accountants would just set up self-managed super funds. You want one? Here, have one. But, it comes with a lot of responsibility, and it's not for everyone. So, as much as it might look, 150 each, you've got 300,000. ASIC came up and said you need 250 to 300,000 to actually set up a self-managed super fund when it becomes viable and less expensive to run. And that doesn't mean you should have one. So the questions I would ask is, what are your goals? So in order for you to have a self-managed super fund and your partner, I want both of you in come and have a chat to me. And my advice is very goals-based. What is your end goal? What are you trying to do?
Millions of dollars at retirement.
Brilliant. That's what all of us want, right? So then we look at all of these things. When do you want to retire? Now, you don't have to retire at 65. You can retire earlier. But it depends on what you want to do. Now, well, yes. Should have bought property before COVID, I think.
I did, thank God. That's how we bought another house, but that's our house,
Should have done that.
I feel sorry. I should have bought two, but you can't afford, like when you,
Yeah.
But we're very lucky we bought after the lockdown. So very lucky.
Very
but
lucky
not
indeed.
everybody's that lucky. So some people bought on the last, the last boom, and they're probably just seeing results in the last 2 years. So yeah.
Correct.
But yeah. So
correct.
you got to be careful buying now, and that's what
Yes.
we've done. But
Yes.
because we had equity, we've done it. So
Okay.
it's hard. But yeah, so
So
we
that's
should have bought another one back then, I guess, is the
in your
the
super.
dream. Yeah, that's right. Maybe.
Maybe.
Oh, we didn't have enough in our super then. Yeah, there you go.
Yeah, there you
Yeah.
go. So usually I say, let's see what you want to do. Is it right for you? Because with property, as we all know, it is an illiquid asset. You can't sell a bathroom. You can't sell a toilet if you need to have some cash. But it can be viable. And if you're in your 40s, well, you can't touch your super until you're 60 or 65. So you have time. It's a long-term investment. So you have time to sort of wait until the investment, sort of builds value. And that's what's happened. A lot of super funds have grown because they've had property in there and they didn't just buy it last year and sell it this year, right? It's a long-term investment.
Yeah.
So it would be goals-based to see if it's for you. What do you have around you? And then go, okay, let's have a chat. Let's set it up. Let's look at if it's the way, you want to run. You obviously know property.
It goes in cycles, right? So if we're talking 20 years from now, essentially we would have gone through a couple more cycles by then. Like maybe a bit of a down and an up and then down and an up, and hopefully in 20 years' time it's worth maybe $4 million.
It could be, right? But I remember I had this client that bought this property in Dunsborough. And it was a they were renting it out. It was like their dream home. It was in a really good location. It was around about 750, 800, around about there. They bought it. They had it for about 10 years. They retired early this year. Property had gone up to 1.8 million or something. It was nearly double, I remember. And what they had done was they sold their house for $2 million. They bought the $1.8 million from their self-managed super fund, because you can do that. You can't live in it when it's in the self-managed super fund. So they bought it out, living in a $1.8 million Dunsborough home that they bought, 10 years ago. This was obviously COVID had a big impact on the property value.
Especially in Dunsborough and Bustleton and the
Yes.
like. Yeah, down south really went through the roof. Yeah.
And now they have a, $2 million cashed up self-managed super fund to retire on.
Nice.
If they hadn't have done that, he would have sold their home, bought the house for 1.8, had 200 grand left over, and had to go back to work.
Yes.
So
wow.
it's a story that doesn't happen for everyone, obviously, but it can happen in the long
How could it
term.
not happen? Again, same question, I guess. So I do have the 300,000 in my in our combined super. So and we've come to you and we've said, look, we've spoken to an advisor. We think we're going to buy an investment property, but we probably need to lend. So there's no property I can buy at the moment for 300,000 last time I checked. So Zayna, help me out. What do I do?
Well, look, the first thing I tell people to do is, we can just run some quick numbers and see if they even can afford it. A lot of people come to us and say, oh, yes, I want to start a self-managed super fund and I want to invest in property. I say, well, can you even afford it first? Let's just run some numbers and then I'll save you this whole, I'll save you this
whole rigmarole, I guess, yeah.
Yeah, the whole process, because it's an expensive process to go through. There's a lot of steps required. It can take a lot of time as well. So if it's not something that you're even close to yet, there's no point if that's your only goal is to invest in property. If you've not got enough money, there's no starting point, especially where the purchase prices are in the market at the moment. So the first thing I'll do is a quick borrowing capacity. And so with self-managed super fund lending, generally lenders go up to 80%. Amazingly, Liberty has been able to go up to 90 now, which has been amazing. And it's I've already had a client who it's made the difference for their self-managed super fund purchase.
Wow.
It's either that or they couldn't buy one. So it's been amazing. The few things that we need to be mindful of there is, we always ensure that there is some liquidity left in a self-managed super fund. So we never use up all of that money.
Yes.
We ensure that a minimum of 10% is left in there for residential or consumer mortgage. For commercial property, it's not as much of an issue.
Yes.
But we want to make sure that our clients are protected.
Why for a commercial
as well.
property is it not much?
So commercial properties don't fit the through the NCCP, so it's the different regulations.
Don't use an
apply,
acronym.
yeah.
What is it? NCCP?
Also, the National Consumer Credit Code.
Yeah. It's a mouthful.
Something like that. Yeah, so it's just something we need to do. It's like any consumer lending is always protected by regulation. Commercial lending is generally not.
Okay.
Yeah. So there's a lot more movement in commercial lending, a lot more things you can do, and that's
Ooh.
because we're not.
Such as? Or let's
we-
get to commercial after. We'll
We
make
can
that
go to
another question.
commercial
Yeah, we'll go to
after.
commercial after. Okay,
Yes.
cool. Let's go back.
And so, yes, I would check borrowing capacity. And there's a few things we need to look for when there's borrowing capacity as well. So on the servicing is completely different. One thing that a lot of people get confused of is, if they're doing a few projects outside of their self-managed super fund, are they excluded from doing anything in their self-managed super fund at the same time? And I said, no, they're completely, mutually exclusive. They do not have any connection to each other whatsoever. It's like a completely different entity, different structure, different operation. So you can be doing something in both at the same time. If you're buying an investment property outside in your personal names, and if you're buying something in your self-managed super fund, you can do both at the same time.
So wait, hang on. To go back to just clarify. So I've set up, we're going to first go through the numbers and set up whether it works for me. But my personal situation with just buying the big house and all of that is not going to be a factor in
Completely
the
irrelevant.
self-managed super fund borrowing capacity.
Yep.
Okay, fantastic. So it's
Completely
going to look at, what are they going to look at? They're going to look at,
So we do look at your overview of your assets and your liabilities, how you spend your money, how much savings you've got. But that's just gives the lender a little bit of confidence in your application, just to mitigate any risk. They just want to make sure that you are asset-backed, you are responsible with your lending outside of your self-managed super fund. I guess the reason for that is also self-managed super fund is in the first two words as well, self-managed. And we have to be really careful when we're talking to people about self-managed super funds, because a lot of people don't realize you cannot touch that money, and it's very touchable. It's there. You've got access to the bank account. You can move the money if you wanted to, but we've got to be really careful that people understand the implications of doing that, and they have to have a lot of self-control. And only people who are responsible with their money and have that self-control really can self-managed super fund be something right. I'm sure Poonam will agree to that one too. If someone's irresponsible with their money outside of their self-managed super fund, we just don't want to be doing the wrong thing and encouraging them to get into an SMSF when they may touch that money. We just don't want them to dip into that. Yeah.
Yeah, got you. Okay, cool.
Yeah.
So there's a little bit, we'll now head, I guess, to the setup. So I've gone to you and you've sort of said, because I know for everybody's sort of reference that you guys kind of work together a bit, like a lot, like with different clients. So somebody will be working with Poonam on, the financial strategy, and then they'll come to Zayna, double check the, capacity to borrow, then come back to you for the setup. So I guess let's go back to Poonam for the setup and what that goes through. So we've been to Zayna and Zayna said, yes, this is viable. This is a great option for you. You can lend up to probably this amount of money. So let's say 750 in our case, maybe, to buy a property. So then we come back to you and you would say,
Okay, I'm just gonna touch back on what Zayna said. She's absolutely right where she said, so a lot of clients who want to buy property, I do send to Zayna first to see what the borrowing capacity is like. But a lot of people don't realize as well, if she says, the property, we don't really have enough, we have an incubation period. So we go, okay, this is what you have in your super fund.
Yeah.
This is what you need to have to be able to borrow this. How do we build this?
Oh,
so that's a good step to actually starting, because the whole process, which will bring me to your setup question, is a long one, right? It takes ages to set something up. And if it is for you, then it might mean let's just look at what we can do to incubate it.
Yeah.
Are you better off keeping it where it is at the moment and like enhancing that? Are you better off having a self-managed super fund and incubating it that way? Or what are your options?
Yeah.
Okay.
Oh, absolutely. And I think, I'm forgetting about the financial advisor side too, because it is so beneficial, because it's not just about go buy a property, because I guess I see that side from clients when they've already done all the other work, but it is about their long-term financial goals and what works best. So if it is a property later, it's going to take them time. So you should see someone to see if that's the goal that you want to have or where it is and if that's the right option. Now on that, if it isn't property, you do with the other options too, right? So you go
Correct.
through, shares or if it's
Yeah.
gold or like wherever they feel. And do you find that for any of those that it's better to stay in your super fund and you can still manage it, or a self-managed super fund is still a better option?
That's a really good question. It's exactly what Zayna said. It's self-managed, right? So whenever I set up self-managed super funds for clients, I always say, think of it like riding a bike for the first time with training wheels. So even though you think you can do it, the training wheels, I'm your training wheels. We will have them on until you're ready to go. Because one of the biggest breaches within the SMSF sector is lending money to yourself. Exactly what Zayna said, is people just take money and go, I'm gonna pay it off, and then they don't, right? So generally, you can do it in the industry funds or whether the fund is really good. But I love ETF investing, exchange traded funds. It's low cost. It does really good things. And sometimes when people obviously want to have gold and silver, you still have with the self-managed super fund, it doesn't always have to be property. You have choice. You can invest in things that you couldn't invest in with the retail funds. However, again, it's very individual. Self-managed is self-managed. If you're going to be someone who can't manage it, it's going to stress you, you've got to get tax returns done, you've got to get an audit done, then let's incubate it where it is and then move it out.
Yeah, when it's ready to purchase and there's no money in there.
Yeah, that's right. Because you don't want to take it out and people are using it for their business and we're like, we were supposed to buy a property with this. What's happening?
What is the penalty for that?
Oh, there's huge penalties and also could be jail time. So
Really?
the ATO.
That's insane that it's my money and you know what I mean? Like I get it, but isn't that insane though?
ATO is pretty good, I have to say. In my experience, I know they get a bad rap sometimes, but they actually allow you to fix the problem.
Oh, that's
and
good.
they ask you to fix it, and they ask you to fix it, and they ask you to fix it.
It's only if you really do.
Yeah, it's when you just don't listen. And really, if you are, you shouldn't have a self-managed super fund.
Yeah, that's
because
right.
you're not listening. So yeah, the penalties are not great, and it does happen a lot, but people just need to be educated. It's what, going back to your point before about why don't they teach this in schools and stuff. People need to be educated to go, this is for your retirement. Treat this with the respect it deserves. You can't just touch it. You couldn't go to one of the retail funds and say, give me 50 grand.
Yeah, that's
You
right.
can't do that same to yourselves.
Yeah.
And I find that that's the key. When clients are educated, they don't make these mistakes.
Yeah.
It's when they just think they've heard something, at a barbecue and a friend of them has got one and they go and set them up, because there's people out there that will set a self-managed super fund up without advice.
Yes.
And so then these people end up doing the wrong things or buy the wrong, properties or wrong investments or get into Ponzi schemes and stuff like that. So that's why I always say, get a plan, speak to professionals like, yourselves, make sure it's right for you.
On that side, I must admit, recently, because property prices in Perth have jumped even in the last 2 months, probably 2 months ago were seeing, with all the talk about self-managed super funds and also the super regulations that Labor was trying to bring through for, unrealised capital gains and stuff like that, I did see a big shift in people setting up self-managed super funds. But then I also saw some people who probably might have never hit the 3 million setting up self-managed super funds trying to buy a property. And I don't know where they got their advice from, because their budgets were so small that they couldn't really buy a property that would give them the returns that they needed at this time. And so that's another thing. I guess that's even the property side of it. You need to find a property that's going to hit the numbers that you need, have a good rental return and give back to the super if you don't have a decent amount of equity that you're putting into it from your self-managed super fund.
100%.
So, yeah, it's very tricky. But, yes, let's get back to the setup.
Oh,
I've
yes.
jumped again.
Okay.
Damn it.
Okay, so the setup. So you've spoken to Zayna. She said, great, you can do this. You've come and spoken to Poonam. She said, yep, financial planning, this looks great. We're going to buy a property in here. This is what we're going to do. We're going to do all these other things outside as well, and we're going to set you up.
I love all the other things too, gold and silver and all the things that everyone's talking about right now.
We're going to build property.
Can you buy Bitcoin in that too?
You can.
Now, but was it,
You can buy, you can. Yeah, you can buy crypto, you can buy foreign exchange, you can buy commodities.
Okay, there you go. That's
You can buy, I mentioned exchange traded funds. You can buy ETFs over gold, so you don't need to hold the gold bullion. You can actually buy it on the market, which for me, liquidity is a big thing. So if you wanted to sell it, you could sell it within, a day or two.
Yeah.
But let's get back to the setup.
Yeah, sorry, yeah.
So we've gone, okay, this is great. And what's involved here? So everything's come back okay. A self-managed super fund is for you. The numbers, work. You're going to have this investment. So the first thing we have to do is we have to set up a self-managed super fund. So superannuation, not just self-managed, including your other super, is a trust. It's held in trust for you for when you retire, then you can access it. Yes, it's yours, but it's in trust. With your retail and I'll call them the APRA regulated funds, you're the member, but the trustees are the APRA funds, your funds out there. They make decisions based on you, on your behalf, what's good for you, what investment profile you're in, and all that stuff. In a self-managed super fund, you're the member, but you wear another hat, which is the trustee. So the first thing we have to do is set up a trust structure. The trust structure is a self-managed super fund structure, and you can only have up to 6 members in there. So you can't have more than 6 members. It used to be 4. It got increased to 6. So only 6 people can be in the one fund at the time. Now, that trust needs a trustee, someone who's actually going to run it. You can have corporate trustees, which is a company, and you can have individuals. I never recommend individuals. I always recommend a corporate trustee. So a company, a PTY Limited, that only sits on top of the self-managed super fund as trustee, and it's special purpose. So it has the, a lower fee from ASIC, and all it does, it doesn't do a tax return, it doesn't have financials, it just sits to give you protection. And the good thing with that is, for example, if you were going to set a Zoe self-managed super fund, it would be Zoe PTY Limited, and let's say you and your partner got in, and then you decided you wanted to bring your kids in, they just become directors of the company when they're 18 and all that sort of stuff. You don't have to change the assets. So, but if you bought it in your partner's name, the property title, you got to change the title every time you bring in new members and you take it out. Asset protection. So that's the first thing. Trust and a trustee structure. That's your self-managed super fund. It's got to be set up. It's got to get a TFN and ABN. The ATO goes, yep, this is valid. It's complying. Once that happens, then we look at rolling money from your existing fund into the self-managed super fund. Bearing in mind, insurances. A lot of super funds have insurances, and you don't want to mess that up because some of them are old and really good. So you want to have that looked at by a financial advisor to make sure that you've got the right insurances in place. Can they be moved to your self-managed super fund? If not, do we leave them where they are? What do we do about that? So it's a very, very important step, because the amount of times I see people just rolling all the money in and then their insurances lapse, and then, they've just been diagnosed with something. Well, they can't be insured, or they have huge premiums. Don't mess with that stuff. You've got to be careful.
Yeah, absolutely. Oh, yeah, because, actually, all mine are currently through my super. So what do I do? Can you have both? Can you have some in that to keep that ticking along, and then some in a self-managed super fund?
Yeah, you can. So usually when you're younger, it's not too difficult to move it into a self-managed super fund. As long as you don't have any health conditions, obviously, that you previously didn't have in the retail fund.
That'd be good training for the kids too, I imagine. They have to manage a bank account that they can't touch. Gosh, that would be so hard for a child, right? That maybe I'll do that for my boys. Like, here's your bank account. You got to put all your super in here. You're not allowed to touch it, and you have to invest.
Have a super plan for them. And then obviously it goes through something called SuperStream. ATO verifies everything and verifies you're the right person, because there's a lot of scamming going on. It goes through something called SuperStream, and then it lands into your bank account. And that's when you then go and see Zayna and go, okay, we're starting to look at this property side of things. And then after that, she's like, okay, do this. Then we have to set up 2 structures. Again, depends on whether you're borrowing or not borrowing. So if you had $1 million and you were buying an $800,000 property, that ends there. You set up the trust, you set up the trustee company, you roll the money in, you go buy your property. Easy. But if you're going to borrow and you've got $300,000, you want to buy an $800,000 property, you've got to borrow. You have to set up 2 other entities. You have to set up something called a bear trust. And this is a trust that holds the asset on your behalf, on the super fund's behalf, while there's a borrowing in place. And the reason why the government brought this, so you have a trustee, again, similar structure, a bear trust with a company as trustee. So you have 4 entities right now. And the reason why the government did this was because super's protected. They don't want people going bankrupt and losing their money and all of this sort of stuff. So what they say is it's held in this particular bear trust while the loan is in place, because if you were to default, for example, let's just say something really bad happened, you couldn't pay your mortgage, it wasn't rented out, the property value declined, that is the only asset the bank can hold and take. They can't access your other super. It's protected. That's why it's a little bit difficult. It's a couple more steps, but it's protection. It's really protecting your asset for the future. And once the loan's been paid off, you don't need that structure anymore. You can dismantle it, maybe use it to buy another property, and keep
Once
doing
you got
that.
it might be handy to just keep it there, right? Like,
Correct. And that's where Zayna's been absolutely paramount, because big question people have is, what name do I put on the title and when do I sign the bare trust and all this. So I work quite closely with Zayna because I set all the stuff up and then I'm like, here you go.
Okay.
And she
now
just does
over
all
to
the
you.
hard stuff.
Yeah. And now what happens?
Yeah.
All right. So we've done all of that. So we've got our bare trust and we've set it up. So say my 300,000 is now sitting in the bank account, and I've set up the bare trust to then get ready to apply for a loan from Zayna to purchase.
Yeah. Well, so one of the great things is that we set up the bare trust for all of our clients. So through Liberty, we have access to our own legal team, so they do all of our bare trust documents. So what I usually tell my clients is to choose what name that they want to do, and first thing we always tell them is to make sure that they know exactly what they're going to be putting on a contract of sale, because that's one of the most important things that we've got to get right. We just don't want any implications down the track. I mean, there are ways to resolve if there was any issues, but the main format and, things that we need to write in the contract of sale as the buying entity are really important, because we've got to have all 4 of those entities listed on there.
As a buyer's agent, I actually always email the lawyer or the accountant and ask them secondary to the client to send it to me. And then I copy that and put it on. Otherwise, some of them are super long too. Like Sydney ones, as we were talking about, are very long. So,
Yeah. And what I've done, with Poonam is we write it out for the client. So all they have to do is copy and paste. And I've checked all the entity names, all the ACNs are there. It's in the right order. It's got the right abbreviations, everything's like that, ready to go. And then just make sure that they're in the right understanding for their, finance terms and that as well, and settlement terms.
Yeah, fantastic. So then they would go off and purchase, and then it comes. Oh, actually, that's good. Is there a pre-approval in place then? Would you do that for a self-managed super fund?
So we can do pre-approvals. Pre-approvals are valid for 3 months. A lot of the time at the moment, because the market is moving so quickly, that can lapse, but it's not a huge issue. We can just go back to the lender and say, okay, well, can we just renew this for a little bit longer? It generally just means that the buyer's just got to redeclare that all of their information is still correct. So we just got to get another document signed, consent form signed, and just
go from there.
Just redo that, and then that's valid for another 3 months.
Yeah, that's fantastic.
But what I do, it's a little bit tricky because sometimes you don't know how much you're going to pay for a property.
Yeah,
so
you don't.
And balancing the the LVR with the deposit amount, with the purchase price, with the rental yield, it's sometimes a lot to do in a pre-approval, and then you've got to go and change it all later. So long as I'm comfortable with doing the borrowing capacity manually, I often tell clients, look, this is what I'm comfortable with you doing. If you get closer to this, we're in the semi-danger ground. But at the end of the day, you're always going to be protected with the finance clause. So if it's something you're going to do, and we can tackle it later, but I'd rather you didn't.
Yeah.
But it gives them that choice.
I like that. Now, you mentioned before commercial property. How is it different? And for you, when you've seen clients look down that path of self-managed super fund, what would you say between the difference between, sort of residential and commercial from your part?
Well, so in commercial, the main difference is obviously we don't have a liquidity requirement, so you can use up all your deposit if you want to. We wouldn't generally advise people to go all the way back down to zero.
No.
It's very dangerous, especially if you have any untenanted period. You've got any
Unless you're the
repairs,
tenant.
maintenance, costs you need to pay for.
Yeah.
You've got no money to work with. So unless someone is going to be putting some extra funds in there, I wouldn't advise anyone to go back down to zero.
Yeah.
But there's a few things we also need to be cautious of as well. One of them is GST. So GST is something we need to make sure that the client has the capacity to pay for upfront, because that needs to be paid for, and then obviously that can come back round, provided it's not a going concern, in which case both parties wouldn't have to pay GST because it's just going to go round in one circle. The ATOs might as well just, make that one negligible. So that's something the accountant or financial planner could confirm for us. So that's one thing we would check if GST is applicable. That can make or break a purchase actually, because a lot of people don't realize that if they need to have GST and have it up front, they just don't have that much money. You know, they thought that that's all the money that they were going to put towards the deposit, cover the stamp duty, and then they completely forgot about the GST. So if there's no GST payable because it is a going concern, a lot of the time clients have a little bit more borrowing capacity as well.
Yeah.
So it's just a few things to be mindful of there.
Yeah.
And then the purpose as well. So for commercial property, you'll find 90% of the people investing in commercial property in their self-managed super fund, it's because there's other benefits to them and they're self-employed. So they're wanting to occupy the premises themselves. In that situation, there's a lot of, ways that we can work out servicing and work out capacity. We don't even need to see historical contributions. We can actually take accountants' declarations and say, okay, well, your business has got the capacity to pay the rent into the super. Your business has also got the capacity to pay you additional contributions if you were needed to have them. So we're comfortable.
Oh, so it's a
with your
big circle,
position.
really.
Yes.
Like you're paying off the property yourself directly, but it's kind of, it's the only way because you're not allowed to live in a residential purchase.
No.
But you are allowed to occupy as a business commercial purchase.
So there is requirements there as well. It's obviously got to be an arm's length transaction, so it needs to be a completely separate entity. So it cannot be in any of the same entities that your super fund is set up in. It's got to be a separate operating business. There's got to be a formal lease in place, and it's got to have a market value lease as well. So you can't, give yourself 50% off in your lease, or times by 3 to try and get more money into your super fund. These kind of things are managed, and we've got to also be careful there how you're using your money.
Yeah. It's not free rent, it's long-serving rent. Yeah. I'll say about the yawn too that my son, the 2-year-old, never sleeps the night before a podcast. It's like always on schedule. Like I don't know why. It's just a crazy person. Anyway, so I think that's interesting because I have seen quite a few people trying to purchase commercial properties for that reason. But it's really hard also to buy commercial properties at the moment. They're like few and far between probably for that reason. So, but yeah, it's probably a beneficial thing to consider and look at if you have money in your super to be able to purchase the property and you're paying rent, right? Is that something that you see often, Poonam?
Yeah, I do actually. Commercial properties are quite common in self-managed super funds. A lot of business owners, I mean, why wouldn't you if you could afford it? Like, if you're renting a place and you have a business, you now have changed that to actually renting the property, real business property in your super fund. So you're thanking your future self because you're paying rent to yourself.
Yes.
And a super fund's tax rate is 15%. Your company's tax is between 25 and 30%. Or if you have a trust, you might be at the highest marginal tax rate. So you're getting a deduction at that higher level, even if it's 25%, and you're paying 15% tax. When you're 60 and retired, or let's just say 65, and you're in pension phase, as the current rules are, that's tax-free. So all of a sudden, that rent now that you were paying 15% on is tax-free. And if you sold that property and made, $200,000, $300,000, $400,000 when you retire, there's no capital gains tax, obviously, depending on this $3 million rule that comes through and the changes that go through.
Oh, I hate that. I think it's so wrong.
Yeah, well, they did announce they're not going to tax unrealized gains.
Yeah.
So that's good, and looking at, all these different things that they're going to do. But it makes sense to put that into your fund because by the time you retire, you would have paid it off. And then you can choose to either, if you've wound down your business, you can choose to sell the property or you could choose to keep leasing it to whoever else is now running the business. It just makes sense. Commercial is great because all you get is rent. All the outgoings are paid by the tenant.
Yeah.
So you don't have any of the problems.
Yeah.
So it's a really good way if you have your own business, especially because that way, it's going to be rented.
Yeah, that's right. And even if you're just renting an office or something and somebody else is helping pay all the outgoings and that kind of thing. It's fantastic. You're
great.
paying yourself for later.
Yeah.
It's like forward savings, like you said. Yeah.
You're actually renting it from yourself.
Yes. Yeah, I'm thinking about that now. I was like, no, I want an office. No. Maybe do that.
Funny enough, there's actually different restrictions when you actually do go to buy a commercial property outside of your self-managed super fund. So generally you'll have to put a lot more deposit down, where in super fund you don't. You can leverage up to 80% LVR. So a lot of banks are not really taking the risk on some commercial properties at the moment outside of SMSF, and so they're requiring a lot more down payment and looking maybe somewhere between 50 to 70% LVR, whereas in your self-managed super fund there's a bit more protection, so lenders are willing to go up to 80.
Wow, that's interesting. Very interesting. And I think, do you think it's a sign of the times that you're able to loan up to 90% at the moment, like for property, that maybe people behind the scenes can see that the trajectory is still upwards?
Yeah, look, there is some confidence there. I mean, lenders are only going to do it if they know that there's something in it for them as well. And now the 90% that Liberty is able to do, that is for residential property only, not for commercial. And
isn't that interesting too? Should we just predict based off what
so that's just at the moment, it's a very new policy. So it's just something we're adjusting as it goes. I'm not speaking on behalf of Liberty. I'm just the messenger.
Absolutely not. No, I think, obviously everything that we talk about today, you have to seek your own, as we said, financial advice. And also we are not crystal balls, so nobody knows what's going to happen. But I think that obviously there are people that are privy to different stats and data that maybe we don't see or have access to, that might mean that their confidence, like at a 90% LVR, is perhaps a bit more they're confident, obviously, because you wouldn't do that unless you were confident, that things were going to continue on the trajectory that they are now.
Yeah. But also a lot of lenders, they'll have different niches, so they want to find a way to help you.
Yes. Yeah, that's true. Yeah, of course.
I mean, they want to help you get into debt, but we want to make sure you get into the right kind of debt.
Yeah.
Look, there's always a process, and we just got to make sure that you're doing the right things at the right time. That 90% LVR is not for everyone.
Yeah.
We do really have to make sure that there's a reason that's the only way forward, and we're not putting someone into any financial distress by doing that.
So I guess what I'd like to know is from both of you, like, what are some of the top questions you get about people wanting to set up a self-managed super fund? So, Poonam, besides the one I already asked, should I do it or not? Like, what are some of the big ones?
One of the big one is, do I have to have millions of dollars to set one up?
Yeah.
That's usually one of the questions that I get asked, and no, you don't.
Yeah.
Because for me, it's really self-discipline. You can have $1 million, but if you were someone who's going to spend it all, then yes, no, you shouldn't have a self-managed super fund.
Yeah, no.
But, if you have $500,000 and you're going to actually look at it, build it, then absolutely you should.
Yeah.
So that's one of the questions. The second one is, when they have one, what shall I put on the title? And the amount of time people get that wrong is crazy. What names should you have? We've got different lenders. There's different rules within the different states.
Yeah.
So that's one of the other questions. The other one, the third one, I'll leave it at 3, is I have a residential property in my self-managed super fund. My daughter's turned 19.
Oh.
She needs a place to live. Can she live in my property? No, nobody can live. No one related to you can live in the property, and that is your uncles and your aunties and your grandparents and your kids and your grandkids. The net is really, really wide, and if you're a business owner, so if we were in business together and partnership, we become.
You can't know the person at all.
Yeah, well, you can be friends.
Oh,
friends is okay.
Okay,
friends is okay.
So
as
my
long
daughter's
as you've
friend
never
can live there, and she can live with her.
Well, no. The daughter's friend can live there, and anyone not related to you can.
Yes, okay.
But that's the number one question, because people get confused with the commercial and the residential. Residential, no one related to you can live in there.
Why is that? If it's like the same for commercial, it's like the distance part. But if it's market rent, like, why is that?
That is the $1 million question. Why is that? It's just the way it is.
It's the way it is. It
doesn't
make any sense that I would use my money. They're paying market rent, right? Like, I don't understand.
Yeah.
Like, I don't understand why the law is there.
Yeah.
Especially in this crisis. Like, if I'm going to buy 3 properties in my self-managed super fund, whoever the hell I want should be able to live there, right?
Correct.
Okay.
Yeah.
Well,
Great
let's
question.
take that one out
Let's
to
do
the
it.
airwaves. Somebody tell me the answer, please, because I don't understand. Because I guess then we go back to I can use my self-managed super fund to buy a commercial property that I can rent, but I can't use my self-managed super fund to buy a property that my children in 25 years can rent off me at market rent. That doesn't make any sense, but that's the rules, right?
Yeah.
So let's stick to the rules. That's the rules. But if I had an investment property and I'm still getting the same, tax deductions and depreciation, whatever, from the investment property that I've bought in my husband's name and whatnot, then they can rent that one.
Correct.
Yeah, okay.
Correct. And it has to be market if you want to claim the deductions and all that stuff.
Yeah. And they do check that because I actually heard that from another accountant recently where someone was giving it under market rent
Yes.
and then they got into big trouble and had to pay
Correct.
back some difference. So
Because you can't deduct everything when you're not charging the right rent, right?
yeah, I understand. I can get that and I totally understand that. That is fair. Do you know what I mean? Like market rent, you're claiming a tax benefit for doing it, negative gearing and that comes up quite a bit, like obviously we shouldn't do it for more than one or two properties, but really when you look at the numbers like I do, it doesn't work out even if you do have that there sometimes. And we need investment properties because otherwise there's nowhere to rent.
Correct. Correct.
So I guess, it's very interesting point, but
It
yes.
is an interesting point, and it is. And then there is farmland, which kind of sits in the middle, and that's probably a conversation for
A whole
another day,
one.
because there is a residence on there, but there's also business function. There's different rules in there, so that's
Can you buy that with your self-managed super fund?
yes, you can buy farmland as long as it's okay. We got to find out what it's for, right? So if you buy
A
farmland,
vineyard
and
with
there's-
a whatsy-doovie or
yeah,
something.
so there's rules. So there's a lot of farmers in Australia, which this whole $3 million rule that you were affecting was going to affect them, because they've bought farms in their self-managed super funds years ago that have gone up in value. So yes, farms you can, and if the rules are right, and obviously seek advice, but you've got to make sure people obviously have to live on the farm to run a farm. So that is the bit in the middle.
Another company?
That is
Maybe
the bit
they're
in the
the
middle.
company that rents the farm off
No,
the
so you know
self-managed
how you
super
can't
fund?
live in the property and
Yeah.
now you've got a residence and a business? There's different rules. It's very complicated. But yeah, so just think if it's a farm, it can't be a hobby farm or something, whatever, or Airbnb or whatever. It's got to be a farm, a running
Yeah.
farm. It has to qualify for real business property, and the residential has to be incidental. So it's not. It's like having a hotel,
Okay.
and you can have this in your self-managed super funds and renting rooms out, and
Yeah.
say you had to live in one because you had to manage it.
Yeah.
There's rules with all of this sort of
Okay,
stuff.
fine.
So it's quite a complex area, and there's many ways to do it. But yeah, this is why I say
And now with the rule, it
advice.
might not be the best way to do it anyway?
Well, they're not taxing unrealized gains anymore.
Yeah.
They've got two limits with the 3 million and the 10 million. So it's each situation. So it sounds worse than it is. I did some calculations for someone who had like 5 million, and I think the extra tax was like $7,000. It's not big.
Huge.
But
yeah.
again, it might be a conversation where if you're going to be making, $3-4 million worth of property investments, maybe the self-managed super fund's not for you. I don't know. It's still changing. It's not law yet.
Yeah.
So we'll
Yeah.
see. We'll watch this space.
Yeah, let's see what happens. And I think
Yeah.
maybe a change of government might kill it anyway. So who knows? Yeah.
One more thing. I know you were short of time, but one more thing is that when I've got clients who come to me who are in their 60s and they've got all this debt outside, they've got in residential properties, and they've got loans on their own home, and they want to come and buy a self-managed super fund with another borrowing, that's usually something I would be like, that's too much debt for you at 60 something.
Yes.
Probably not the right decision. So that's
So now would be, I guess, but now's a good time, I guess, in our 40s with 300 sitting there, like to at least speak to an advisor and to go down and a broker and go down that path and see if it's viable.
Yeah, definitely.
Yeah.
All right. Well, I think, okay, well, I guess I've got a referral for you both.
Thank you.
Yeah, but I think, I think it's scary, but I feel like for some people, when you see your savings goals go up, I get excited by that, like in something that's separate. So you have to know if you're that person, I guess, or the other person. Are there people that can manage that bank account for you, or you don't want them to do that? That's too much trust.
Yeah, they can. Financial advisors and things like that. But
Yeah.
you still have control.
Yeah,
so
and
self-managed
access,
super
yeah.
fund, you can't go, you need to know the rules. So when we set one up, I go through 60 minutes, if not longer, an education session, and we go through it over and over again, because at the end of the day, you're responsible for it.
Yeah, that's right.
Yeah.
And you don't want to ruin your future or your
Yeah.
kids' future either.
Correct. Most people do the right thing.
Yeah.
Yeah.
Okay. Yeah. Yeah. That's
I mean,
good.
one of the easiest ways of doing that is making sure that you have a separate bank for your self-managed super
Yeah,
fund.
that's a great
so
idea.
don't mix it maybe in the same ones as you would your, personal
Yeah, not
transaction
easy to
accounts. It's an easy
transfer.
way, but that's not financial advice.
That's
That's just an easy way to keep
yeah.
it separate. That's what I've done myself. It just means that it's completely separate. I'm not going to see it when I'm doing my normal
Yes.
banking.
Yeah.
I'm not going to, by mistake, spend any of the money.
Yeah, that's it.
Yeah.
I think that's a great way to be.
Yeah.
That's awesome.
I will touch on one thing that I actually do get asked a lot when it comes to
Yes.
self-managed super fund. Can I use my equity? No, you
No.
cannot.
Because it's separate.
You
yeah.
cannot use your equity to leverage a second purchase in your self-managed super fund.
In your self-managed
Yes,
super fund. You
yes.
can't-
So if you're
so-
wanting to grow a portfolio as such in your self-managed super fund, you cannot pay down one property and use the equity as leverage for the second property. You can't do that.
Yep.
So it's very important that you get your lending right from the beginning, because if buying multiple properties is your goal, then I would go as far up the LVR as possible with minimal deposit so that you've still got some money left for the other investment property purchases, because you cannot use that. You cannot leverage properties. Every property is
Interesting.
completely
And you
independent.
don't want to sell if you've bought low, but I could see there'd be, because that's like how everybody gets caught, right? Like, because if you sold, when it's high to buy the other one, you can really still only buy another one, so
Yep.
you've got to try and build your capacity, because everything's grown by then. So you
Yes, so
can't sell high and buy two more. You need to keep it there
Yeah,
for the
only
20-year
way-
growth strategy.
Correct.
The
Yeah.
only way you can release that is by sale.
Yeah. Yeah.
So if you're wanting a second property and you've got one that's completely paid off but no deposit, the only way to do that is if you wanted to sell it.
Yeah,
and then you
okay.
could maybe use that to buy two. But then it's,
Yes.
whether or not it's worth it for you.
Oh, my head's hurting because I did just think that you could, if you had another investment property on the side in your personal names, you could leverage the equity of that to put that money into your super to buy. No? You can't make a deposit in your super?
You can. There's implications. That's something you
Oh.
need to discuss with an accountant or your financial planner.
Poonam.
Yeah.
That's where I go, handball.
okay,
These are
yeah.
some options. Why don't you
Yeah.
check if there's
trying
contributions
to
you
think.
can make? Why don't you check if,
Yes.
there's any implications? I can give a lot of ideas, but at the end of the day, the client is responsible to go back and get the right advice.
Yeah. I think it's about having I actually even heard of someone recently who sold a lot of Bitcoin thinking it was a great idea and then had a massive capital gains tax bill. So, I think you've got to make those decisions with any of those big things with, the advice of your accountant or financial advisor,
Correct.
to
Yes.
make sure that it's to make sure, and sit down and be sure. But yes, I think that's amazing. And what about any other questions, Zayna, or common mistakes probably as well for you, because you probably see both, which we've talked about the entity name a bit, but
Yeah.
yeah, what are common questions for you?
I guess equity is probably the most common question. Some of the other ones are the ones Poonam mentioned. I get asked about house and land packages a lot in
Yes.
self-managed super fund, because obviously a lot of people are finding it really difficult to get into property and they're wanting to do house and land package instead. Unfortunately, through Liberty, we don't do that because we believe it's not necessarily in line with the, with
We
the
can't
government
rent it straight
legis-
away, so it's not making an income straight away,
it's not
right?
making an income, and you also have multiple drawdowns.
Yeah.
But I think there are some lenders out there that do it.
Yeah.
There are some ways to do it if that's something you wanted to do. I'd probably have to do, a fair bit of research. It's not something that I would be able to assist with.
Yeah.
But it is a question I get asked because sometimes it's the only option that people can afford right now. And if they're wanting to do that in their self-managed super fund. Vacant land is also another, but if you did that, you will definitely not get a loan for construction.
Yes.
And vacant land, I'd probably say if you were going to pay cash, then you might be able to do it. I don't think a self-managed lender will lend you money to buy a vacant land in your self-managed super fund.
Yeah, interesting. And I mean, a newer property does come with benefits, I guess, in terms of, you've got full depreciation and other tax benefits and whatnot. But if there is time between it having a rental income that could, look obviously not as good for a lender who is going to.
It can affect your servicing quite considerably.
Yeah.
To be able to use market rent straight away, we can put that figure into your calculations. So we're already using that rental income to make sure that you can afford the property.
Yeah.
So I'm quite careful when I do my calculations. I base it off quite a low yield just to make sure that we're in a safe range. I start off at 4 and then depending 4% yield based on the property purchase price.
Yeah.
But it's quite often higher than that. Can go anywhere up to 6 depending on what type of property it is.
Yeah.
And I get advice from, professionals such as yourself, buyers agents, real estate agents. Once they've done an appraisal on the property, if they're able to give me, more confidence in what they can get the property rented for, then I'm happy to use those figures.
Yeah.
But for the initial borrowing capacity, I calculate always based off a lower yield because you just don't know. And it's always better to be safe there.
For people who do want to purchase in their self-managed super fund and aren't able to have the full, 50%, 70%, to purchase it, and as you said, you would need to talk to your advisor about if that's the best strategy because you can't use equity. People, I think, have this perceived idea that they're not putting anything additional into their super to cover the costs. You are, aren't you, most of the time, if it is, say, me, 300,000 with 750, or it should be covering your costs. Can you explain that process? Because that's probably a question I get a lot from people.
So how to work out servicing?
Yeah.
So the servicing in your self-managed super fund doesn't come from manual contributions. It comes from, say, if you're an employee, it would come from the employee super contribution. So whatever you see on your payslip that your employer is paying directly into your super fund, that's the money we use towards servicing. That and the rental income.
Yeah. See, that's the number one question I get. And I was like, no. But so that's another Poonam question. So that's why it's considered completely separate, and that you're looking at my financials probably just to make sure I'm not going to dip into it, and the ability is there to top up if required. But the serviceability you're looking at for what you're giving me for borrowing capacity is based off the amount of super I'm being paid and my husband into that account.
Yes, and we obviously do want to make sure that you're in a stable employment.
Yeah.
You're not just started a brand new job. You've not just taken 6 months off. There's a lot of things that we want to look for.
Yeah.
Contributions, when you're looking at contributions into a super, if you are making manual contributions, some people are falling a little bit short on servicing and they want to start putting some contributions, but we can't use that because you could stop it at any time. It's manual. So any additional contributions, you have to have at least been making it for 6 months continuously for us to consider it, because we need to see that there's some regular payments happening. Yeah, because at the end of the day, you could choose to stop that, and
Okay, I've got a fun curly one for you then, because most real estate agents obviously are on commission with retainer, like small retainers with commission, and commission payments recently changed, like a few years back. I think that it's now super. Like super comes out of it, so it's not separate, whereas it just used to be on a retainer, which is kind of cheeky, but like I guess it's good for my future self. But so with commissions, are they included or is it averaged out, or how does that work?
So, I mean, I guess it depends on the structure of the employment. If you're under like an employee structure, then your super's paid through as an employee, then we would use that. If you're under an ABN, you're technically self-employed, and then we would look at your super contributions there and assess it as we would a self-employed. So we'd look at business financials and we'd look at using historical contributions you've made, or look at what your potential is to make contributions moving forward.
Yeah.
So there's a lot more flexibility if you're self-employed. So if you're under an ABN, because what you'll find is a lot of self-employed people don't put money into their super.
I know, it's bad.
Yeah. Look, there's a lot of reasons people don't. It's always the best practice is to do that. So the main culprit is those who are under as a setup as a sole trader. And it's mainly cash flow. They just want, they forget as well. And if they're not under the right advice, they haven't been guided to make those contributions to their super, they don't know. And then they get stuck. They're wanting to use that money for something else. And they say, oh, I'll do it next month. I'll transfer a bit next month. They don't. They don't.
Yeah.
So we want to look at historical contributions and look at their capacity to make contributions moving forward. So it is a little bit more risky for sole traders doing it like that. But if you're set up as a company, you're a director, you're paying yourself a wage, we would also look at that, and we'd also look at any capacity to increase that as well.
What about if you're paid a salary but it fluctuates and the commissions are paid from your employer?
it doesn't matter. We would average probably
Yeah,
2
so
years worth.
averaged.
Yep.
Yeah. Okay, fantastic. All right. Amazing. Okay, I think I got that all now. I think that's it. I
Great.
think we've hit it on the head. Thank you both for
Thank you.
coming in and explaining something that I think a lot of people get a great benefit out of, like if it's worth it. And also I'll just say to everybody to go and seek advice. Like if you've got
Yes,
some money sitting
please.
there and you're not sure, first go find your Poonam, but not
Yep.
mine. No, I'm joking. No, she's very busy, but obviously go find her because she's incredible at what she does here in WA. And then maybe she'll just have to create another 5 of you, which is amazing. And or Zayna for any, financial capacity and for borrowing to see what that looks like for both commercial and residential. So thank you both for coming in today. It's been an absolute pleasure.
Thank you for
Thank
having
you.
me.
Yeah.
Or having us.
Yeah.
Thank you so much. It's
Pleasure.
been lovely. Thank you.